Hello, everyone, and welcome back to Audit Decoded by Mayuri. Today's topic is one that lies at the very heart of auditing and risk management, the Risk and Control Matrix, commonly known as RACM. Now, many auditors, managers, and even regulators refer to RACM almost every day, but not everyone truly appreciates its importance. The RACM is more than just a spreadsheet or documentation template. It is the soul of a structured audit approach, the compass for risk-based auditing, and the evidence that organizations are systematically addressing risks. In this video, we'll go into deep detail, not just about what RACM is, but why it exists, how it is prepared, what factors must be considered, and why it is indispensable to modern internal audit. So let's begin. What is RACM? The Risk and Control Matrix, RACM, is a formalized framework that brings together three essential elements of governance: processes, the way an organization operates; risks, what could go wrong in those processes; controls, the measures put in place to prevent or detect those risks. If you imagine an organization as a house, risks are the cracks in the walls and roof, and controls are the reinforcement beams and repair work that keep the house standing strong. The RACM is the blueprint that documents where those cracks are and how they are being repaired. At its core, RACM answers four fundamental questions. What can go wrong? Risk. What are we doing about it? Control. Who is responsible? Control owner. How do we know it's working? Testing approach. A well-prepared RACM typically includes process name and objective detailed risk description, risk category, operational, compliance, financial, IT, etc. Inherent risk rating before control. Control description. Type of control: preventive, detective, corrective, deterrent. Nature: manual, automated, hybrid. Frequency: daily, weekly, monthly, annual, real-time. Control owner and department evidence generated by the control residual risk rating after control. Audit testing strategy and conclusion. This structured view ensures there is a direct line of sight between risks and controls. Factors considered while preparing RACE. Creating an RACM is not a mechanical task. It requires business understanding, risk judgment, and audit expertise. Let's explore the key factors auditors must consider in great detail. 1. Comprehensive understanding of business processes. The first step is to map the process end to end. Without this, risks and controls cannot be identified correctly. For example, in a procure-to-pay P2P cycle, you can't just look at the payment step. You need to see vendor onboarding, purchase requisition, approval workflow, goods receipt, invoice processing, and final settlement. Each step introduces risks, and each step must be documented in RACM. A shallow understanding leads to an incomplete RACM, which means audit blind spots. 2. Risk identification. What can go wrong? Risks must be identified from multiple perspectives: operational risks, fraud, inefficiencies, errors, financial risks, misstated transactions, revenue leakage, compliance risks, breaches of SOX, GDPR, PCI, DSS, etc., technology risks, unauthorized access, system downtime, cybersecurity breaches. Example, in revenue cycle, one key risk is revenue overstatement by booking sales without shipment. Good RACM preparation requires workshops with process owners, risk managers, and IT teams to ensure risks are not missed. 3. Control identification and mapping. Each risk must have at least one effective control. Strong RACM avoids both control gaps, risks without controls, and control redundancy, too many unnecessary controls. Example, for risk of duplicate invoice payment. Control, ERP systems duplicate invoice check, and finances manual review of payment runs. 4. Control characteristics. Auditors must capture control attributes in detail. Nature, preventive, stops risk. Detective, finds risk after occurrence. Automation, automated, system-driven, manual or hybrid. Frequency, real-time, daily, monthly, quarterly evidence, screenshots, logs, approvals, exception reports. Owner, department or individual accountable. 5. Risk rating and prioritization. Every risk is rated based on likelihood and impact. Example, in payroll, risk of duplicate salary payment may be medium, while risk of incorrect tax calculation may be high because of regulatory consequences. This rating drives audit sampling strategy. Auditors spend more time on high risks. 6. Control design versus operating effectiveness. RACM should distinguish between design, is the control conceptually sufficient, And operation, is it actually performed consistently? Example, a policy may say invoices above $10,000 need CFO approval, good design, but if CFO signs without reviewing, effectiveness fails. 7. Testing approach and evidence strategy. RACM guides the audit plan. How will auditors test the control? Common methods: walkthroughs, inspection of evidence, reperformance, inquiry, system configuration checks. Example, to test a SAP three-way match control, auditor may select a sample of invoices and check if the system blocked mismatched purchase orders. 8. Regulatory and industry context. RACM must embed compliance requirements. In SOX audits, financial reporting risks dominate. In PCI DSS, focus is on cardholder data security controls. In banking, regulators may require specific RACM structures for operational risk. 9. Dynamic nature of risks. Risks evolve with time, technology, and regulation. Example, 10 years ago, cybersecurity phishing risk might not appear in RACM. Today, it is mandatory. RACM must be living, breathing, and continuously updated. Why is RACM important in internal audit? Now let's answer the most critical question. Why does RACM matter so much? 1. Guarantees risk coverage. Without RACM, auditors might miss major risks. With RACM, every material risk has at least one mapped control ensuring completeness. 2. Audit roadmap and testing framework. RACM is like the audit GPS, showing exactly which controls to test, why, and how. It eliminates randomness and ensures consistency across engagements. 3. Supports risk-based auditing. Internal audit today is not about ticking boxes. It's about focusing on high-risk areas. RACM provides the foundation for this prioritization. 4. Facilitates external audit reliance. External auditors, for SOX or statutory audits, often rely on internal audit RACM. If RACM is strong, external auditors place more reliance, reducing duplication of work. 5. Improves management accountability. Every control is linked to an owner. This eliminates confusion and finger-pointing. Accountability is crystal clear. 6. Helps identify control gaps and redundancies. RACM reveals if some risks lack controls or if multiple controls exist for the same risk unnecessarily. This helps management optimize control costs. 7. Regulatory and board assurance. Regulators, audit committees, and boards demand evidence of structured risk management. RACM serves as documentary proof that risks are identified and mitigated. 8. Training and knowledge transfer tool. RACM also becomes a knowledge repository. New auditors or managers can quickly understand a process and its risks by reviewing RACM. Practical examples of RACM. Let's explore 2 real-world examples. Example 1. Procure to pay, P2P and Oracle ERP risk, unauthorized vendor creation leading to fraudulent payments. Control, vendor master changes restricted to accounts. Payable team with workflow approval. Type, preventive, automated plus manual approval. Frequency, every vendor creation. Owner, vendor master team. Testing, review ERP configuration and sample vendor creation logs. Example 2. Revenue recognition in SAP risk. Overstatement of revenue due to early recording of sales. Control, SAP configuration restricts invoice posting unless linked to delivery note. Type, preventive, automated. Frequency, real-time. Owner, finance manager. Testing, inspect system config, reperform invoice posting, and check exceptions. Both examples show how RACM links risk to control and enables audit testing. Conclusion. To wrap up, the risk and control matrix, RACM, is not just a checklist. It is the foundation of effective internal audit and the heartbeat of risk-based assurance. It documents processes, risks, and controls with precision. It ensures completeness and consistency. It empowers both auditors and management to focus on what truly matters. It supports regulatory compliance, external audit reliance, and strong governance. In simple words, a good RACM is the difference between an audit that merely ticks boxes and an audit that truly adds value and protects the organization. So, the next time you prepare or review an RACM, don't think of it as paperwork. Think of it as the compass, shield, and roadmap of internal audit. Thank you for joining me today on Audit Decoded by Mayuri. If you found this session insightful, please like, share, and subscribe to the channel for more deep dives into auditing, ITGC, ITAC, cybersecurity, and risk governance. Stay tuned for the next episode, and until then, keep auditing with confidence.